dive into something called the Fibonacci Freedom Formula. It's based on source material making a pretty big claim.
A very big claim, yeah. That everyday people, folks like you listening, can use this simple pattern from nature to actually multiply their money in the Forex market.
Right, the foreign exchange market. And the idea is that this pattern helps your money kind of trade for you. Our mission today, let's unpack that. Does it hold water?
Well, first, Forex itself, it's huge. We're talking the world's biggest market. Over $7 trillion moving every single day.
7 trillion. Wow.
Yeah, and that constant movement, that liquidity, is apparently why these patterns can even work. The sources argue it's reliable, time-tested.
And they say you don't need a finance background or like tons of cash.
Nope, just internet, a trading app on your phone or computer, and crucially, this specific strategy. That's the pitch.
Okay, so let's get into the strategy itself. It hinges on the Fibonacci sequence. You see this pattern everywhere, right? Like seashells, sunflowers.
Exactly. It's this mathematical thing found all over nature. But the sources claim it applies directly to financial markets, too. It supposedly structures how markets move.
But how exactly? It's not like you see a spiral on the price chart.
No, it's about the ratios derived from the sequence. Specifically, the key ones for this strategy are 38.2%, 50%, and 61.8%.
Okay.
These are presented as the potential buy zones or entry zones. They're used with what's called the Fibonacci retracement tool.
Retracement.
Yeah.
So like when the price pulls back?
Precisely. After a market makes a move, say, upwards, it often pulls back a bit before continuing. These percentages are supposed to show you where it's likely to pause or bounce.
And there's a psychological reason behind this, according to the material?
Yeah, the idea is that markets are driven by collective human psychology, fear, greed, and these ratios supposedly reflect predictable points where those emotions shift, where the herd impulse maybe runs out of steam.
So it's like a map for entry and exit points based on crowd behavior.
Kind of, yeah. A potential map based on these recurring patterns.
Interesting. Okay, so if the theory is psychology, the actual trading needs to be super mechanical, right? Objective.
Absolutely. Cold and objective. The source material lays out a pretty condensed 5-step process. Should we walk through it quickly?
Yeah, let's do the rapid summary. Step 1.
Identify the main trend. Is the market generally going up, making higher highs and higher lows? Or is it going down? You need to know the overall direction first.
Makes sense. Step 2.
Draw the tool. You use a trading app, like TradingView is a common one, and you draw the Fibonacci retracement tool. For an uptrend, you draw it from the recent lowest low point up to the highest high point of that move.
Okay, tool drawn. Then step 3 is finding the entry.
Yep, the entry zone. You watch and wait for the price to pull back to retrace and actually touch one of those key levels, 38.2, 50, or 61.8%.
So you wait for the price to hit the zone. But wait a sec, if everyone knows these levels, couldn't big players, whales, target them, mess with people?
Good question. And that's where step 4 comes in. Confirm and manage risk. You don't just blindly jump in when price hits the level.
Okay, so what's the confirmation?
You look for specific signals on the chart, usually candlestick patterns. The material often mentions things like a pin bar, which visually suggests a market tried to push lower but got rejected right at that Fibonacci level. It's a sign the level might hold.
Confirmation first.
Got it.
And risk management.
Non-negotiable. You must place a stop-loss order. Usually that goes just below the recent swing low point that formed before the bounce. And you absolutely have to aim for a good reward-to-risk ratio, like risking $1 to potentially make 2 or even 3. That ratio is key.
So the discipline there protects you somewhat from manipulation.
That's the idea. Discipline and probabilities. You won't win every trade, but the goal is that your winners are significantly bigger than your losers over time thanks to that ratio.
Okay, makes sense. And the final step.
Yeah.
Step 5. Taking profit.
Right. Take profit. And you don't just guess where to exit. You use another Fibonacci tool, the extension levels. A common target mentioned is the 161.8% extension level, projecting where the price might go after the bounce.
So entry and exit are both tied to Fibonacci levels. It's a complete system.
Supposedly, yes. And this structured approach, especially the risk management and letting winners run to calculated targets, is what leads to this freedom effect they talk about.
Which isn't about getting rich quick, but
slow, steady, predictable growth. Compounding, that's the focus.
Getting an example, right. Starting small.
Yeah, like starting with $500. If someone could consistently make just 2% growth per week, which sounds small, but it adds up.
2% a week.
Yeah.
Over 3 years, that $500 could become, what was it, over $9,700.
Exactly. That's the power of compounding those small, consistent gains. It's not about hitting home runs.
And there was a case study, a nurse.
Right, Lisa. Started trading weekends, learned the system. Within about 8 months, wasn't making millions, but was consistently earning an extra $300 a month. Predictably. Enough to fund her travel savings. It highlights the consistency aspect. That's the freedom, not necessarily quitting your job tomorrow, but building reliable extra income.
So for you listening, the takeaway here seems to be that the goal presented is financial stability. It's achieved through this repeatable pattern-based method with strict rules.
Mm-hmm. And maybe the final thought to leave you with, pulled from the sources, is this. Freedom isn't about quitting your job. It's about knowing you can. So how could that kind of predictable, consistent growth, even if it starts small, potentially rewrite your own financial story? Something to think about.